Every time you enter a trade, someone more experienced is happily taking the other side of it. The uncomfortable truth in smart money trading is that the crowd usually enters at the worst possible price and feels most confident right when it does. In this video, I am going to show you how to flip that with 5 entry models: the breaker block, the fair value gap, the mitigation block, the inversion fair value gap, and the order block. None of them are about predicting the market better. Each one marks a spot where retail emotion and institutional intent collide, so you stop guessing and start entering where the smart money does. By the end, you will know when to enter, when to stay out, and how to read what the other side of the trade is feeling. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. So let us get started. Before we touch a single chart, understand this. The hardest part of trading is not finding the trade. It is surviving the 60 seconds before you take it. That is when doubt, impatience, and the fear of missing out do their real damage, and where most good ideas quietly turn into bad entries. An entry model exists to protect you from exactly that moment. It replaces the feeling of, "I think now is the time," with a condition that either happens or it does not. No guessing, no chasing, no negotiating with yourself while the candle is still forming. And it is only one piece of a bigger structure. A complete trade rests on 3 things: identifying the optimal area of interest, waiting for confirmation, and executing through a well-defined entry model. The first 2 decide where you are willing to act and whether the market agrees. Everything that follows is about the third: turning that decision into a precise, repeatable entry. Let us start with the first one, the breaker block, the spot where the crowd gives up and institutions quietly load. Before we go deeper into the setup itself, let us briefly review what a breaker block is and why it matters in market structure. So, what is the definition of a breaker block? A breaker block is a previously failed order block that transforms into a key supply or demand zone on the price chart. This happens when an order block is broken in the opposite direction, shifting its role from supply to demand or from demand to supply. In practice, a breaker block helps mitigate positions and often becomes an area where traders add to their positions. There is also an important principle to keep in mind. Whenever price breaks through a key demand or supply zone without showing respect, that zone automatically shifts its characteristic. A supply zone becomes demand, and a demand zone becomes supply. The same principle applies to order blocks. Now that we understand the core idea behind breaker blocks, let us return to the entry model itself. Among all my setups, this is one of my favorites for reversal entries, and the reason is as much psychological as it is technical. This pattern forms in a way that suggests price is more likely to reverse. However, for this setup to be valid, the move has to begin from a meaningful higher timeframe zone, a higher timeframe fair value gap, a supply or demand area, or a spot where price has just swept liquidity from a major swing high or swing low. You cannot take every breaker block that appears randomly in the middle of nowhere. In trading, context is everything. With that in mind, let us look at exactly how to execute an entry using this model. At this stage, we zoom into a lower time frame and closely monitor the market for signs of reversal. The first condition we need to see is a clear market structure shift, or a strong change of character on the lower time frame. This becomes our first layer of confirmation. For a valid bullish breaker block, price should initially form a swing low, followed by a swing high, and then create a lower low. After this sequence, we need to see an immediate expansion move to the upside that breaks structure and confirms the shift. In this scenario, the up-close candle, or the series of up-close candles that form between the first swing low and the swing high, becomes your breaker block zone. That is the area you use to plan your long entry. To execute the trade, place a limit order at the highest point of that mitigation block and wait for price to retrace into it. For profit taking, you can target the nearest liquidity on the current time frame or aim for a higher time frame key level if you expect a larger move. The bearish breaker block follows the exact opposite logic. In this case, price should first form a swing high, then a swing low, followed by a higher high. After that, we need to see a strong bearish displacement move that breaks structure and closes below the swing low, confirming the market structure shift. Under these conditions, the bearish breaker block zone will be the down close candle, or the series of down close candles formed between the first swing high and the swing low. To apply this entry model, place a limit order at the lowest point of the breaker block and wait for price to retrace into it. Your stop loss should be placed a few pips above the zone. For the take profit, you can target the nearest external liquidity on the same time frame, since we expect price to continue moving in that direction. Alternatively, you can aim for a higher time frame major liquidity level to achieve a better reward to risk ratio. Finally, if you prefer a more refined and slightly conservative entry, you can place your order at the midpoint of the point of interest. This approach often improves the risk to reward ratio by tightening your stop loss nearly in half, while also potentially doubling your R to R. Breaker blocks are often the main reason why price does not return to a fair value gap that forms immediately after a liquidity sweep or after tapping into a higher time frame area of interest. In many situations, breaker blocks are positioned slightly above or below the fair value gap. Because of this positioning, price is more likely to react from the breaker block first instead of fully filling the gap. That said, it is important to keep one thing in mind. When a breaker block overlaps with a fair value gap, that confluence significantly increases the probability of the setup. This overlap makes the breaker block zone much stronger and more reliable as an entry model. Now, here is what is really happening at that level. When price failed at that zone the first time, it left an impression on everyone watching. So when price returns to the breaker, the average retail trader reacts to that memory instead of the current structure. Recency bias tells him, this level already failed once. It will fail again. So he sells into it or refuses to buy, convinced the move is dead. That reaction feels safe, but it is exactly the mistake the setup is built to exploit. Institutions read the same candle the opposite way. To them, that failed level is not a warning. It is their mitigation point, the price where they add. So at one level, you have two traders drawing two opposite conclusions. The crowd assuming failure, the smart money seeing opportunity. Your edge is not predicting the candle. It is recognizing that split and choosing to stand on the side that is acting instead of the side that is hesitating. Now let us move on to the second entry model, the classic fair value gap, the imbalance the crowd walks past and price keeps coming back to fill. Among entry techniques, this is the most common model, and it is considered a hybrid, meaning it can be applied to both reversal and continuation trades. To illustrate the reversal approach, let us consider a bullish scenario. The first condition is that price is reacting from a significant higher time frame level, or that it has just taken out a major pool of liquidity. Once this occurs, we need to see a market structure shift on the lower time frame. This becomes our first layer of confirmation. After the structure shift is confirmed, and we anticipate that price may continue higher, the next step is to look for a buying opportunity. At this stage, our focus shifts to identifying a bullish fair value gap that forms within the impulsive leg of the market structure shift. These zones often behave like magnets, drawing price back before the upward move continues. From there, we plan our buy entry by placing a limit order at the highest point of the fair value gap, while positioning the stop loss a few pips below the recent swing low. The bearish variation follows the same logic, simply mirrored in the opposite direction. From a personal perspective, I do not usually prefer using this model for the initial reversal entry. Instead, I primarily use it as a continuation setup, adding another position after price has already moved in my expected direction, and my first trade is running in profit. Still, whichever way you use it, this is where the psychology bites. A fair value gap exists because one side overwhelmed the other and left an inefficiency behind. Most retail traders see that empty space and read it as strength. The move looks powerful, so they chase it, entering late and far from any logical stop. What they miss is that the gap is not a signal to run after price. It is an unfilled debt the market tends to come back and settle. Smart money treats it the opposite way. Instead of chasing the impulse, they wait for price to return into the gap and enter where risk is small and the imbalance is being closed. So the same feature triggers two different reactions. The crowd feels urgency and jumps in high. The professional feels patience and waits for the retrace. When price comes back to fill it, you are not guessing. You are standing exactly where the imbalance was always likely to be resolved. Next, let us move to the third entry model, the mitigation block, where trapped traders get one last chance to exit, and you get your entry. Among reversal setups, this entry model is considered one of the most powerful you can use. As with the previous models, this pattern only carries weight when it develops off a higher timeframe decision point, or right after a major liquidity grab. Without that higher timeframe context, the setup loses much of its strength. For a bullish mitigation block to develop, price must first create a swing low, then a swing high, followed by a higher low. After that, we need to see a strong bullish displacement move that breaks structure and closes above the previous swing high. In this scenario, the bullish mitigation block becomes the last up-close candle or series of up-close candles formed between the first swing low and the first swing high. To execute a long trade, place a limit order at the highest point of that mitigation block, with the stop loss set a few pips below the nearest swing low, and wait for price to retrace and activate the entry. It is important to note that this differs from a breaker block. With a breaker block, we look for a lower low to form, rather than a higher low. The bearish mitigation block follows the exact opposite structure. Price must first form a swing high, then a swing low, followed by a lower high, before a market structure shift occurs with a bearish displacement leg that closes below the first low. Under these conditions, the mitigation zone becomes the downclose candle, or the series of downclose candles, formed between the first swing high and the swing low. For the take profit, you can target the nearest opposing liquidity on the current time frame, or aim for a higher time frame key level when you expect a larger move. Think about who is trapped at that block. These are traders who entered at the worst moment and are now offside, watching an open loss. Instead of accepting it, they hold on and hope, telling themselves they will exit the moment price comes back to break even. That is loss aversion at work. The pain of realizing a loss feels worse than the risk of holding, so they wait rather than act. When price finally returns to that level, all of them try to escape at once. That wave of relief selling or buying creates a concentrated pocket of liquidity right where they exit. And that is precisely where smart money steps in to take the other side. So their emotional decision to wait and pray becomes the fuel for a cleaner entry. Their exit is your entry. Now let us move on to the fourth entry model, the IFVG, the level that flips the instant the crowd's conviction breaks. Before we look at how to execute this setup on the chart, let us briefly review what an inversion fair value gap is and how it forms. So what exactly is an inversion fair value gap? An inversion, also called an inversed FVG, occurs when a previously identified fair value gap fails and price invalidates it. For instance, imagine a bullish imbalance that creates a clear gap on your chart. As price retraces back into that area, the expectation is a continuation to the upside. However, if the following candles close decisively below the gap, fully violating it, the market has disrespected that level, and this failure forms the inversion. Now, let us understand the psychology behind the inversion FVG. The appearance of an inversion fair value gap is often an early indication that momentum is shifting. It reveals that the side responsible for creating the original imbalance has lost control. This change in strength can signal a potential reversal in direction. From basic price action principles, we know that after a breakout, previous support can become resistance, and previous resistance can become support. The same principle applies to fair value gaps. When a bullish fair value gap that once acted as a demand area is broken to the downside, it transforms into a supply zone. As a result, we can anticipate a possible rejection from that inversion FVG toward the downside. So how can we determine whether a fair value gap will hold or become an inversion? When trading fair value gaps, what we want to observe is price returning to the zone and respecting its midpoint, which often leads to a continuation higher. If instead price trades into the area and clearly violates that midpoint, we can anticipate further downside, with candles closing below the fair value gap and forming an inversion. To mark the midpoint manually, simply measure the range of the gap from its low to its high and identify the 50% level directly on your chart without relying on any indicator. Now, there is an important detail to understand. Fair value gaps are considered one-time use. Once price has reacted to an FVG and the market has already delivered a move from it, we no longer treat that same gap as a fresh trading opportunity. If price later breaks through it, we do not classify that as an inversion FVG. When searching for a true inversion, we want to see a sharp shift in momentum that fully disrespects the gap from the start. This brings us to the question, fair value gap or inversion fair value gap? Which one is superior? In reality, neither is better than the other. Both can be highly profitable when applied under the right conditions. They represent different types of setups, each with its own advantages and limitations. In general terms, the inversion behaves more like a reversal strategy, while the standard FVG aligns with trend continuation. For that reason, inversion setups often offer greater risk to reward potential. That said, fair value gaps appear more frequently on the chart, whereas identifying a clean inversion FVG that meets all your criteria can be more challenging. In addition, once you identify a valid inversion fair value gap, you typically do not require extra confirmation to execute the trade. Now that we have reviewed the concept, let us return to the entry model itself. In a bullish scenario, a valid IFVG entry needs price to be working from a higher timeframe point of interest, or to form just after a major liquidity sweep. From my personal experience, the cleaner the liquidity grab that precedes it, ideally taking out a major swing high or swing low, the more reliable the entry becomes. Once the IFVG forms, it often holds as a new support zone, providing a solid area for a potential buy entry. When placing an entry using this model, you generally have two options. The first option is to enter immediately after the inversion fair value gap forms, placing your stop loss below the most recent swing low. The second option is to place a buy limit order at the highest point of the newly formed IFVG and wait for price to retrace into it. For the take profit, you can target the nearest buy-side liquidity on the current timeframe, or aim for a key level on the higher timeframe. The exact opposite logic applies in a bearish scenario. This model is powerful precisely because it captures a moment of broken belief. Traders who trusted that original gap bought it expecting support to hold. When price closes decisively through it instead, the level they were counting on flips against them, and their assumption is suddenly wrong. That is the setup for cognitive dissonance. The chart no longer matches what they believed, and they hesitate instead of acting. That hesitation is what makes the reaction so sharp. As price rejects the failed level, those trapped traders are forced to cut positions, and their exits push price in the new direction with real speed. You are not guessing at a top or bottom. You are entering the instant the crowd's conviction cracks, and their forced selling or buying does the work for you. Now let us move to the fifth and final entry model that I use, the order block, the footprint smart money leaves behind before it moves the market. This entry model is also a hybrid, meaning it can be applied to both reversal and continuation trades. Within smart money concepts, it is one of the most basic and widely used entry methods. Order blocks represent the footprints of smart money, areas where institutions initiate positions, typically at the origin of a strong move. These zones act as decisional areas, where large volumes are placed before a major expansion, which is why price often reacts or reverses when it returns to them. In a bearish scenario, the bearish order block is the last up-close candle or the series of up-close candles formed right before a strong bearish move that causes a break of structure. On the other hand, a bullish order block is the last down-close candle or the series of down-close candles formed just before a strong bullish move that leads to a break of structure. From my experience, I mainly use order blocks on higher timeframes, such as the 15-minute chart or higher. I generally avoid using them for entries on very low timeframes, like the 5-minute or 1-minute chart. To execute an entry using this model, price first has to reach into an important higher timeframe zone and start showing signs of a reversal. After that, we zoom into a lower timeframe and look for confirmation, such as a clear change of character. Once the change of character is confirmed, we identify the last up-close candle at the origin of the bearish impulsive leg that caused the market structure shift. That candle becomes our lower time frame bearish order block. This is the level where we place a sell limit order and wait for price to retrace and activate the entry. The bullish order block follows the same logic, simply mirrored in the opposite direction. However, it is important to remember that lower timeframe order blocks are more likely to remain unfilled, so managing expectations and risk becomes essential. And that is the whole point of an order block. It is a literal footprint, the exact price where institutions committed real size before the market ran. When that move happens, most retail traders react to the momentum. They see the strong candles, feel the fear of missing out, and chase price far from its origin, which leaves them holding a poor entry and a wide stop. The professional does the opposite. He ignores the excitement of the move and marks where it began, because that origin is where the real decision was made. Then he waits, patiently, for price to return to it. So the same expansion produces two reactions: the crowd chasing on emotion, the smart money waiting at the source. Sitting patiently at that footprint instead of running after the move is exactly what separates the professional from the crowd. Notice the thread running through all five. Every one of these models marks the same thing: a price where the crowd is reacting on emotion and smart money is acting on the opposite read. You are not memorizing 5 random setups. You are learning to recognize that split and stand on the disciplined side of it, again and again. Master that, and a correct bias finally turns into precise, well-timed entries. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.